Can you believe we're at Chapter 5 already? In this chapter, we're going to learn about internal controls. Now, we've talked about that our ultimate goal is to provide financial statements that are accurate, timely, relevant, usable, and internal controls help us get to that goal. The financial statements are a record of where the company has been and a tool to use to plan for the future. And if those financials are not accurate, then what's the point? But, you say, if we do all of our transactions correctly and we make our adjusting entries at month end, the financials should be accurate, right? Well, maybe, but we need to still check and make sure that they're accurate. We don't want to just depend on somebody's ethical nature or their competence to say they're correct. You know what assuming does, don't you? So we're going to learn how to figure out if those financials are correct so that we have that secondary check to make sure. Internal controls help ensure that the business gets the appropriate information that it needs. Now, many of these controls have been used by company for years and years and years, but the Sarbanes-Oxley Act of 2002 requires that publicly traded companies present particular reports about the effectiveness of those controls. Now, we have better internal control. We hope to prevent fraud and theft, although you can't prevent that 100%. And the investors, stockholders, creditors have more confidence in the reports that they are reading. Internal controls want to safeguard your assets. What are a company's assets? Well, all of the equipment, furniture, fixtures, things like that they have. But what about the cash? Isn't that a company asset? And accounts receivable. All of those things we need to safeguard, and it takes more than accounting entries to safeguard those assets. Accurate information, we've already talked about that. We haven't really talked about compliance with laws and regulations. That's a little bit outside of accounting, but internal controls help assure those also. Now, most of us will never work for publicly traded companies. So again, we say, what's the point? Well, every company, no matter how small, needs to have accurate information. And I say that word accurate often, so obviously that's important to me. Even the smallest company needs to do things to ensure that that information that they're presenting to their bank, to potential investors, is correct. So what are internal controls anyway, and what do they do? Well, first of all, we need to think about the control environment. That's part of internal control, and what procedures we put in place. The risk assessment. Are there risks that the company faces? And I think when we say that word risk, we think about, oh, is there a thief in the building or something like that. But there's many, many risks that a company can fall under. What about their product? Is it a product with a long life, or do they need to be constantly renewing and improving and updating their product? What about outside risk? The economy, for instance. That's something companies worry about all the time. And not just the local economy, but national and worldwide economy. It all plays into a company's risk. What control procedures do we have, and what monitoring do we have of those procedures? And then we need to have the information, but not just have the information, communicate that information. I like this particular piece, the control environment. Well, we all know that old saying about what rolls downhill, right? One of the major influences on the control environment is management. Is management ethical? Do they operate in a style that we want to emulate? Because if the employees of the company feels that management operates in ways that are incorrect, the employees are going to act the same. They're not going to care about ethics and morals and legalities of various issues. The organizational structure is also very important. Sometimes those structures get so big that having control is very difficult. And personnel policies. And that one I place pretty low on the list. Obviously it's low on the list here. But you can have all the policies in effect that you want. But if the company as a whole does not embrace it, if the corporate environment is not such that you believe in those policies, they're not going to be followed. The risks of a company need to be identified and communicated so that we can take steps to control them. One of the things that was on a previous screen was talking about laws and regulations. Those change all the time. The EPA, the DEA, all those alphabet pieces of the government are always updating and changing their rules. So we have to constantly identify any risk that may be there. Banking has changed a lot over the years, and that's something that really impacts accountants. Control procedures. So how do we do this? Well, controls are the measures, procedures, performance indicators, and other methods that we use to check and regulate the business operations. And it's systematic. It's not just a hit and miss thing. Sometimes we do this, sometimes we do that. We need a systematic system in place. Now, internal controls, while they will help to check on the accuracy, they're not going to ensure that everything is 100%. But they go a long ways towards helping us be satisfied with the accuracy of our information. In addition, I want you to remember this. Internal controls do not make sure that a company is profitable. This is not about profit. This is about accuracy. Things we can do. Make sure we have competent personnel. Rotate their duties. Call it cross-training if you would like. That way everybody knows how to do other things. Mandatory vacations. Sometimes people don't like to take vacations. And the United States is the worst for people leaving vacation days on the table. We need to do it for ourselves, simply to clear our mind and regroup so that when we come back to work, we're ready and once again engaged, but it's also a great time to check someone else's work. Separating responsibilities. One person collects the money, somebody else does the deposit, somebody else takes it to the bank. Makes sense. And separation of operations and assets and accounting. Somebody prepares a purchase order. Receiving department checks it in. The accounting department checks the invoice against what was originally ordered. Those sorts of things help make sure that everything is accurate and taken care of. Internal controls can be preventive, catch it before it happens, or detective, find it after it happens. And we all see controls every day of our lives. Think about security cameras in store, clocking in when you go to work. Those are all control procedures. Now, I've talked about the fact that most of us will work for small companies that are not publicly traded. I'd like to bring to your attention two accounting principles that are not covered in the book, but I think that are important. One is called the principle of conservatism. That says that the accounting for a business should be fair and reasonable. Accountants need to make evaluations, deliver opinions, and select procedures. What we're going to talk about as we go through this chapter is very involved and requires a lot of people. Small companies don't have a lot of people often. So sometimes the accountant, in conjunction with the owner, needs to select which control procedures are in place. The other principle is materiality principle, and it requires accountants to use GAAP, except when to do so would be detrimentally expensive or complicated and would make no real difference. Obviously, publicly traded companies have to follow GAAP to the letter, but smaller companies may be able to do some procedures that are not exactly GAAP approved, but fit for the company as it is. All right, we need to monitor our systems. You can't just put a system in place and 20 years later go back and review it. And that is true of many things that we do. But in control procedures, we need to monitor it and see if it is effective. And not just us, but other people need to be brought in and ask their opinions. Is this working? Does it do what we have it in place to do? As the world changes and technology changes, we have to update our controls all the time. We talked about how necessary it is not only to have the information but communicate the information so that the company as a whole understands what's happening. There are limits, and I've already mentioned this. Humans. We're wonderful, aren't we? No matter how many controls you put in place, there's always somebody that will seek to find a way around those controls. Happens all the time. And the other one we've also talked about, you have to weigh the cost against the benefits. So there are limitations. We're going to talk about internal controls involving cash. That's one of the company's biggest assets. Cash involves a lot of things, whether it be in the bank or cash on hand. We receive cash from sales, and you can see this diagram if you can follow it all. Comes in, goes one place so that it could be put into the bank, goes somewhere else so someone can account for it. I'll let you follow the little arrows. Cash received in the mail, just as important. You have someone that opens the mail, someone that takes it and does the accounting work for it, and someone else that takes it to the bank. Now, cash in the mail, as soon as you get the check, I believe you've probably learned this in maybe business math. As soon as you get it, that check needs to be endorsed, so no one can cash it without authority. And also, banks now will generally not cash business checks, so it's very difficult for a check to be stolen and used. And again, we have our arrows that I'll let you follow. And most of us are very familiar with electronic funds deposits, whether it's direct deposits for your paycheck or your car payment or mortgage payment is directly deducted from your bank. A lot of transactions involving cash now are done electronically. That helps prevent some fraud, but what about the person in the company who is authorized to make electronic transactions going somewhere else? Control needs to still be involved in those transactions. Cash payments, we've talked about needing to separate duties and keeping the flow so that we don't bog down the system. So when somebody issues a purchase order and the merchandise is received, it needs to go through some other steps before the check is actually issued to a vendor. Most of us, if not all of us, have bank accounts. Bank accounts are wonderful because they help keep our money in, I was going to say a safe place, but sometimes you wonder if that's really safe or not, don't you? But it prevents the company from having to keep large quantities of cash on hand. We can use checks to denote that we want some of that cash to go somewhere else. We can take the cash on hand and put it in the bank. On our side, our cash is an asset because we own it. On the bank side, the cash that we put on deposit there is a liability because the bank owes it back to us. So take a moment to look at this slide and see how things are different. They're mirror images of each other between the company and the bank. Bank reconciliation. That's probably enough to make you hyperventilate, isn't it? How many of you actually reconcile your bank account? Or do you log on to www.doihavemoney and just check your bank account via your login at your bank's website? Many people no longer reconcile their personal bank accounts because of the ease of checking on transactions and their balances. Not saying that's a bad thing, but it's not really a good thing either, because with not doing that, we can often miss mistakes, errors that the bank makes, or fraudulent activities. A business must do a bank reconciliation. This is an example of how it's done. We compare the cash balance according to the bank with the cash balance according to the company. And by looking at what is different on each, we should be able to make those numbers match. It's not as difficult as it may seem. Trust me on that one. So what we're going to do is look at what is in our books and not on the bank statement. So we're going to find any checks that are outstanding. And an outstanding check is a check that we have written and recorded in our books, but it has not cleared the bank yet. We're also going to look and see if there are any deposits in transit, meaning we've recorded the deposit in our books, we've taken it to the bank, but it is not yet showing on our bank statement. And that can happen if you do a deposit on the last day of the month after the bank's cutoff time. You have it recorded as, let's say, July 31st, but the bank might record it as August 1st. So we need to look for those items. We then need to also look and see if there's anything on the bank statement that is not yet in our books. And those things might be things like interest earned or bank service charges. And then we also need to make sure we have not made any errors in recording anything. And you can see here that once we do those steps, our balances, our adjusted balances, match. And that's what we're trying to get to make sure that everything is correct on both sides. Let me go back to that for just a moment. One thing I want to note here is anything that is on the bank statement but not yet in our books must be recorded in our books. So we have to make transactions after we've done our bank reconciliation. If you took business math, you stopped at this point. But now, because this is an accounting class, we must record these items. Anything that is in this top part where we're making additions and subtractions to the balance according to the bank statement, we do not need to make any transactions for, because these items are already in our books. Most companies also keep a petty cash fund. That's a small amount of money, a couple $100 maybe, that the company keeps on hand to pay for small items that they may not want to write a check for, or that just happen infrequently. Let's say the company gets the newspaper for the local community, and they want to pay the paper boy. Or the office manager decides to buy lunch for the office employees. Those sorts of things. When the fund is initially established, we would make a transaction moving the money from our cash account, which is our bank account, to a petty cash fund. What's important here is after that entry, unless we are either decreasing or increasing the amount we hold in petty cash, there are no more entries to petty cash. When you replenish the fund, you're going to write a check for the amount that you need, which should be the total of the receipts that you now have, and you're going to apply those receipts to the appropriate accounts and put the cash back into the petty cash box. I always think of it as a metal box for some reason. Now, we're going to see another change in our financial statements on the balance sheet. On current assets, instead of listing cash, petty cash, and anything else that we have that might be cash related. Cash, bank, savings account, payroll account. They're listed as simply cash and cash equivalents, so that you total those all into one line item on the financial statement. Then in the notes to the financial, you show the various pieces of that cash and cash equivalent. Financial ratios. You know, at the end of every chapter, we look at ratios so that we can begin to understand how to do analysis with our financial statements. So if we look at our ratio of cash to monthly cash expenses, we can tell how long a company can continue to operate if they're reporting negative net cash flows from operations. And I believe I've mentioned to you about negative cash flows from operations. It can happen, but if it happens continually, you've got a company in trouble. So we need to look at this particular ratio. We're going to take the total of our cash and cash equivalents and divide it by monthly cash expenses. And then we can determine how many months the company can operate on the cash it has on hand. We take that net cash flow from operations and divide it by 12, and that will tell us how long we can. I just messed that up completely, didn't I? To determine your monthly cash expenses, you take your net cash flow from operations and divide by 12. We'll get to how long the company can continue to operate. Wow. Sometimes I either read too fast or lack comprehension as I'm talking. All right. Here we go. Net cash flows from operations. It's negative for year 1 and year 2. We also have our cash and cash equivalent amounts from end of year. Using those numbers, if we take our net cash flow from operations, divide by 12, we get our monthly cash expenses. With that information, we can then take our cash in bank, divide it by the monthly cash expenses that we just calculated to determine how many months we can operate based on the money we have in the bank. Now, this is not taking into account any loan payments that we may have, any capital expenditures we may need to make. This is strictly looking at our monthly cash expenses. So for this company, you can see that in the first year, they did not even have 12 months of cash available for operations, but that has been improved in the second year. All right, and with that ratio, we are at the end of Chapter 5. Now, I imagine as you're working on your homework and doing actual bank reconciliations, you're going to have some questions. I will be monitoring the discussion board for those questions.